Thursday, July 6, 2017, Monaco 64, home of alternative economics and contrarian views. So it's after 10 p.m. London, so I'm doing actually an aftermarket review because there's a lot of interesting things happening, especially in the bond market, also in the equity market as well, and their relationship. And the reason I'm doing this video with only like the data and not me appearing in the video is that I've got a lot to go through, and my editing system, my iMovies, doesn't take as much data if I appear in the videos, but I will be back to appearing in the videos. Just that there's so much to go over and to look at right now. So first of all, I want to look at a story on Bloomberg today, and it says Gundlach sees more pain for bond bulls as hedge funds make exit. And who's Gundlach? Well, according to Wikipedia, Jeff Gundlach was formerly the head of a $9.3 billion TCW Total Return Bond Fund. And he was fired in 2009 and founded Double Line, and they manage about $12 billion in bonds. So the guy knows what he's talking about. And today, this is what he's said about the bond markets. The recent sell-off, he says, is a sign of more pain to come for Treasury bulls, according to Double Line Capital Chief Executive Officer Jeffrey Gundlach, whose firm oversees 109 billion, actually, not 12 billion, and said a year ago that yields had hit bottom. So what happened today is that there was a French, I think it was a 30-year auction, French government bond 30-year auction, and the auction didn't go very well. There wasn't too much demand, and yes, yields spiked. The yield spike originated out of Europe. So this is what happened. Let's have a look here. The bond route today. You can see here the German 10-year yield was up 9 basis points at 0.56%, which is still really low. The gilts, 10-year gilts UK, up 5 basis points. And the French 10-year yield was up 10 basis points at 0.91. That's quite a big move. Italy as well, up 11 basis points to 225. Spain, 10 basis points. As a lot of you know, I worked in the bond markets for over 20 years, and you know, these are big moves, especially with rates being so low. Even when rates were at 4 or 3%, a 10 basis points move is huge. And now with rates around 1 or less than 1 in Europe, 10 basis points is quite big. And I just want to show you a chart of the German 10-year yield, the Bund. You know, that is the benchmark for European bonds and also global bonds to some extent, even though the U.S. Treasuries are still the benchmark. But you see, this yield is dropped, you know, all the way to below 0 last year. I think we bought it in July, just like U.S. Treasuries. And now we're at 0.562, which isn't a lot, but we've broken the, as you can see in the chart, key technical resistance at 0.5% or 0.5%. Still a long way away, you know, from where we were in 2014, you know, probably just below 2%. And the thing to remember is as the yields in bonds go up, especially the long-term bonds, the prices start moving down, and the holders of bonds, be them speculators or investors, their capital is chiseled away as the prices go down. Yields go up and prices go down. Especially speculators who have been, you know, riding this QE low interest rate fest that the central banks have provided them since around 2008, 2010 area. And I'll show you a chart here of the price of TLT, which is an ETF unit trust on bonds. It's a 20-year bond iShares, and it's pretty much reflective of the 10-year and somewhere in between the 10 and 30-year, but I don't have data for the continuous 10-year chart. So this is the best that I can do. But as you can see, from like around the time the Fed announced QE2, which is, I think it was around November 2010, that's where that trend line begins on my chart. You can see that since then, the Treasury prices have been on an upward trending channel, and we're still holding the trend line, you know, the support trend line there. The low, you can see there's a low there last year, and it held. And I'll go back to a shorter term chart of this TLT because it will be easier for you to see. So as you can see, you know, we've been above 130 recently, or above 128, and we've dropped quite a bit in the last, this is a daily chart, we've dropped quite a bit in the last few weeks, from above 128 to around 124. And so now, you know, it's whether we can hold key support levels. And if we go back to that the previous chart I just had there, the weekly one, you can see that that support there that we touched on the trend line, that's basically the equivalent of the 2.6, 2.63 yield on the 10-year note. So that's the next key level. Also, the level there just above 100 in 2014, that low, that's when the 10-year yield went up to 3%. So until we break that 3% yield on the upside, the bond market's still under control. But I think if we also break this 263 yield, it would be very interesting to see whether we can break that beginning of 2014 low there on the TLT. And now I'll show you the 10-year yield chart, which should be the other way around from that TLT. And let's have a look here. And this one goes back a few years, and you can see that there in the beginning of 2014, that's the 3% level there. And the two little, you know, the two tops there, end of 2016, end of 2017, that's that level around 260, 263 yield that we, you know, that's the next level resistant for yields. And that's the trend line on that TLT support trend line. So these are really important levels. I think Gundlach is also saying that he sees the 10-year yield trading towards 3%, by the end of the year. And he says if we break that 3%, it's a bear market in bonds. And it's interesting because I made a video exactly, well, about a year ago, in July 2016, and I'll put the link above, or the video above in the iCards, and you can watch that. And I'll also put the one from, I think last week, I made a video questioning whether the, you know, the bond bubble could be unwound by central banks in an orderly fashion. But going back to the historic bull market, you know, because yeah, I guess in July 2016, I made the video asking whether the 35-year bond bull market was over. We hit a low of around 136. Some people have 132, but we hit 136 last July, and I asked whether that was the low for the bull market in bonds, the low in yields, the high in prices. And so far it has held because, you know, today we are, you know, where are we now? I think we closed around 2. Let's have a look here. Yeah, we're right now at 237. So we've gone up, you know, in the last month from below 215, and we're now at 237. So we're about like 1.1% higher from, you know, a year ago. And the interesting thing is that the previous low in yield to 2016 was in 1946, according to ritholtz.com. It says here, and I read from his website, it says the all-time low in the series occurred from April 5th to April 8th, 1946. So just after the war at 154. And then, you know, the top was around 1582 in 1981. So it took basically 35 years for that, from that low of 1.54 to the high of 15.8 or thereabouts. And it's interesting that from 1981, that's 35 years to 2016. So it looks like we've got like a 35-year cycle there. So I'll show you another chart here. This is the 10-year yield again, and it's a little, it goes back to the 1920s, and you can see there the bottom in 1945 and the top in 1981. And, you know, right now we've seen a series of lower lows and lower highs in yields back to 1981. And that's why that 3% level, that would be a break, you know, of the previous high. So it wouldn't be a lower high. That's why that 3% is so important. And the question will be whether the central bankers are able to control the market, especially now that they've all come out and said, you know, that they're going to unwind their QE with quantitative tightening. They're going to, you know, raise rates. Europeans or, you know, ECB saying that they're going to taper. You know, they're not as far in as the Fed is into tightening. So it will be really interesting. And the interesting point about today as well is that we had a stock market rout, so to speak, you know, for the standards that we've had in the last 18 months of low volatility. We had the Dow down 158 points, or 0.75%. S&P down just under 1%, minus 23 points. The NASDAQ Composite down 61 points, or exactly 1%. And then we had, you know, the bond yields were up. In the past, you know, until last year, until the bottom in yields last year, every time stock markets were in trouble, bond yields would drop because it would be considered a flight to safety. But today, for example, the 10-year yield is up 4 basis points, and the 30-year yield was up 5. So that's not a very good signal. And the other thing we saw is that commodities have done fairly well today. The CRB index, which I talked about in my last video, that was up 0.5%. I know it's at, you know, almost multi-year lows, but we're still rebounding of late. We had crude oil today up 0.5%, and we had precious metals as well, according to the Bloomberg COMEX closes. Gold up 0.5%, and silver also up 0.75%. Silver managed to close above $16, which is quite encouraging. And so the question is, will the central bankers be able to unwind 35 years of easy money and high financial asset prices? And why do I say that? Well, because a lot, all financial instruments, their prices are derived from the 10-year U.S. Treasury yield, because that's considered the risk-free rate of return for 10 years. So stocks, other kinds of bonds, all other instruments, derivatives, they're all priced off, the 10-year U.S. yield, government yield. And we've had 35 years where we've dropped, from above 15% in 1981 all the way down to 1.36% last year. And all that's done is helped asset prices higher, stocks, bonds, derivatives, and all because, money has been plentiful and easy to borrow. There's been also the leverage has been easy to take on through derivatives and, zero interest rates. So my question is, are we going to be is the unwind of this bond bubble, is it going to take 35 years just like, the other 35-year cycle? Or is it going to be a lot harder to control? Will it be, a lot more volatile and in a shorter space of time? Well, the central bankers, if they see signs of trouble, they might, go back on their words about quantitative easing, quantitative tightening or higher rates. But if they do that, they'll lose all credibility. And I think that's what's happening already, because people realize that, the last few years, the only reason we've had this continued drop in interest rates and rise in asset prices is because central bankers have promised to keep the monetary spigots open, or turned on. And an interesting interview I heard a year or two ago, it was Stan Druckenmiller. He was either on CNBC or Bloomberg. I don't remember which one exactly. And they asked him, what will happen when the Fed has to unwind the QE? He said, well, it's going to be ugly, because the speculators on Wall Street, they're going to front run the Fed. So that's the problem, you see. They front ran the Fed on the way low in yields, which is buying bonds. Because people have to understand, speculators, they don't buy bonds to get the return or the coupon. They buy it for the capital gains, and they leverage to the hilt. So if the Fed says they're going to start unwinding, you can bet the speculators are going to front run, and it could cause loads of accidents. So really, I'm not saying that this is the beginning of anything here, but as I've said before in my videos, we need to keep an eye on this, on the moves in yields, and also the relationship between stocks and bonds and yields. So if you enjoyed this video, please give me a thumbs up, share it far and wide, subscribe to my channel, and also you can watch me on steemit.com, steemit.com, and follow me there as well. And thanks for listening, and I'll talk to you later. Bye.